Welcome everybody to day 7 of the 30-day Traders Induction here on my channel. So today is the final day of week 1, and what we're going to be doing is beginning that transition from a bit of the introductory theoretical side of things and what trading is and the basics and how one can get involved, and more so moving into structuring and building a trade plan that is appropriate and aligned with your current lifestyle. So with a trade plan comes a whole host of different sectors that basically allow us to print in paper what it is that we're going to doing, so that we can adhere to a set of rules and a set of criteria in an environment that would otherwise have a virtually unlimited number of ways to act within. So with that being said, trading the markets can be done in any number of ways, in any method of ways, with the ability to make as much money as one could lose. There is no limits in this game. It's a completely boundaryless environment. So a trade plan is what allows us to set some structure and set some rules that we can adhere to within the markets to make sure that we're acting in a way that is not only profitable but is also sustainable and scalable throughout time. So day 7, developing a trade plan. First up, we are going to speak about why one should have one. Now, keep in mind that notion of a boundaryless environment, so it is up to us to implement rules to operate within. First up, it helps with making consistent decisions. It's a consistent decision-making process. It helps us to act within the alignment of what it is that we need to be doing. So the markets are random in nature, so the question you might be asking is, how can one produce consistent results from a random outcome environment? And the way in which that one does that is by executing and approaching the markets in a consistent manner with an edge that allows them to not only be right more than they are wrong, but be profitable over time, even if they're not correct on the position more times than they're not. So consistency in the markets is defined by the consistency in the approach, the consistency of the execution, the consistency in the risk management, the behaviors, the routines, the habits that one projects into the markets every time they step into the realm of analyzing and executing within the markets. So consistent decision-making process is very important when it comes to trading, and having a trade plan allows us to really pull and extract that knowledge out of our mind on what it is that we're going to be doing and putting this strategy onto paper, so that when we're looking at the markets and we're perceiving this information, we're not umming and ahhing about what does this mean and what should I do with this information? Is this an entry or is this not an entry? What we want to do is we want to have a plan that acts as a foundation to our trading in the markets that allows us to make that decision-making process on a consistent basis, where the answer will always be determined and answer will always be known, and that will help eliminate this hesitation and this second guessing of this information within the markets. When I say information, I mean the price action, the data that we're interpreting. Now, moving on to the next one is a performance evaluation. So when we're trading in the markets, we may have a very good read on the markets. We're predicting markets well. However, over time, if we don't have a trade plan, how can we refer and correlate and cross-reference our performance against anything if there is no trade plan to back that? So, for example, you've taken 4 or 5 positions. Maybe they look very different. One of them's taking a Fibonacci retracement, the other way, and the other is an EMA break and retest, and the other is just a double top on a weekly time frame. So there's no consistency in that execution. Maybe they've won, maybe they've lost. But if you've not got a trade plan, how can you cross-reference those positions against a trade plan that you know is scalable, is consistent, it's profitable, and it assists with the risk management side of things? How can you evaluate your performance if you've got nothing to evaluate your performance against outside of the profit and loss from each of those individual positions. There's no consistency, there's no scalability, and there's no longevity in that approach. That's just gambling. That's just throwing a bunch of money on red, then black, then red, then black, and going backwards and forwards without having an edge, without having an execution, without having a plan that you can look back on and say, okay, statistically speaking, this is what my trade plan says I can expect to achieve from the markets, but I need to be acting in the way that the trade plan lays out for us. But if you've got no trade plan that has those rules in writing, then how can we refer our performance to anything if not having the trade plan? So helps with risk management as well in two primary different ways. One is the rules when it comes to the financial risk that we put on the market. So are we risking 1%, 2%, 3%, or are we making that decision in the moment in an impulsive emotional state, thinking this trade actually looks pretty good, so I'm going to risk a few percent more. It's not a way of doing it. Another way is to help with stop loss placement. If you've got a consistent approach in the markets, a strategy that you can replicate each and every time, that every time you execute a position, your stop goes in the same place. For myself, that's behind the 0.618 or the 0.75 Fibonacci retracements. Every single one of my positions has the same stop loss placement that allows me to make sure that I am executing in a consistent manner that is adherent to my risk management parameters that say if a position goes against me to the extent of the 0.618 or the 0.75, that's invalidated and we move on to the next, knowing that we've only risked 1 or 2% of the account. We've got stopped out when the trade has become invalidated. Now, risk management as well comes with the rules in which one should do if they take more than one loss on the day. It's a plan that says, all right, I've taken 2 losses on the day. I got to go out and have a walk and clear my mind, or I'm done for the day, or I'm up 3% on the day. I've hit my target. I've hit a few wins. It's time to back off. Whatever those answers are to those questions should be in the trade plan so that when you're executing the markets, you've closed a few positions, either win or loss, you know what to do relative to your objective self, looking into the moment from outside of the moment of what it is that you're comfortable with. I myself know that if I'm taking 2 losses on the day, I ain't really looking to take the third on that same day. I want to figure out what's going on. Have I stuck to my plan? Is something up? I also maybe not necessarily don't want to take any more positions for the day, but be aware that, all right, I'm down 2R. I'm probably on tilt. I need to bring myself back into a sober and balanced mindset before I execute my next position. I need to make sure that the positions that I just took are within my trade plan. They're not erratic, impulsive decisions. And then that can bring me that confidence to say, no, I've executed well. It just didn't play out. So we execute the next. And it's all part of the plan. So it helps again, going back to that consistent decision making process. It allows us to evaluate our previous performance. It allows us to execute in a way that's adherent to risk management procedures. These are all very confidence building things that allow us to execute in a more confident manner. It helps with discipline and focus. With the trade plan, you're outlining a set of rules that yourself needs to abide by, and if you don't, when you have and when you haven't done the right thing. You have an answer, you have a structure and a foundation that you've made for yourself to say, all right, if you breach these, you've done the wrong thing. This is not good. There's no sustainability or longevity in those actions. So it helps to not only be aware of the discipline issues that you have, but it allows you to be aware of them so that they can become points and markers that you can then improve on. If you keep slipping up on the same mistake that your trade plan says don't do, you're able to then clock that and utilize that as a lesson to cancel out that as a consistent habit or an error that you're making on a consistent basis to then improve as a trader. It helps with focus as well. Focus more from an inspirational point of view. If you've got your trading goals and your trade plan, then you can refer back to that, and it can bring a lot of inspiration when you meditate and visualize on those images of that lifestyle that you're so not desperately, but so hardly working towards. So it's very much an important an all-encompassing document that one should look to bring into their trading arsenal. And one thing that I do always stress is that don't make it something that restricts you. Make it something that is inspiring to look at. Take pride in it. Make it look good. Print it off. Laminate it. Have it signed as a professional document. Make it inspirational and make it something that you don't want to not look at. Make it something that you look at with the intention and the understanding that this is going to make me money and this is going to allow me to live the lifestyle that I want to live. So a few elements of trade plans. Number one, trading goals. So the trading goals in a trade plan, again, bring that inspirational side of things. We want to have our immediate trading goals, our longer term trading goals of, we want to be a traveling trader around the world, or do we want to have a nice house with a nice setup with a family around that you're able to be there full time? What brings you inspiration to show up into the market each and every day? What is an immediate goal of making sure that you are executing only the best of setups? You're sticking to your risk management. You're sticking to the habits and routines that you need to do. These are all part of trading goals that can bring inspiration to move forward. Market analysis. This is the part where we are looking at the types of tools and techniques that we're using within our trading toolkit. Are we looking at support and resistance? Are we looking at the volume? Are we looking at the EMAs? If so, make it in a way that doesn't limit you to what you're looking at, but allows simplicity and focus in the markets. If you don't have in your trade plan that you should be looking at the VWAP or the MACD, then there's no reason to be letting the VWAP or the MACD come in and influence your trading decisions. Simplicity is key. Making sure that we're not flooding our charts with so many indicators and different tools that can overwhelm us and contradict each other so easily. The more indicators, the more tools you use, the easier it is to contradict the position. So simplicity and doing what you like and you resonate with is important. But the market analysis is the part of the trade plan that goes in to say, all right, these are the tools and this is the perspective that I'm wiring into my brain that I'm going to use as the lens to interpret the data that is in the markets that I need to look towards and conceptualize into a position and a justification of entry. Trading strategy is then now how you put together all of those tools and techniques into a synthesized procedure that takes you through a routine of step 1 this, step 2 that, step 3 this, execution. It's the packaged version of all the tools and techniques that put together an edge that you can execute consistently in the market to allow consistent profitability and allow an execution in the markets. For example, you want to see a rally up into a resistance level. You want to see a candlestick formation. So then that is your step 1. You've got the support and resistance. You've got step 2, that's your candlestick. Step 3 is now executing this market with a stop and a target at the areas in which you outline in your trading strategy. Risk management. Again, this goes back to, am I risking 1%, 2%? What am I doing if I take 3 losses on the day? What am I doing if I'm on a huge winning streak? Do I need to balance myself out? What do I do in drawdowns? What do I do in up draws? Risk management is the rules and the criteria that you outline for yourself to execute in a way that doesn't let you go overboard from both a financial but also an emotional and mental standpoint. We'll be going over some advanced risk management next week or the week after, so sit tight on that one. And then the routines and processes. So all of this is all well and good, but if you don't have a routine or a process to follow and implement all of these tools together, then what's the point? So the routines are the daily routines. Are you waking up, you're making a coffee, having a shower, then jumping on the charts? Are you meditating? Are you checking the Forex factory calendar? All these different things that need to be brought into consideration that and that you were deciding to do prior to it happening, that these are the things that I need to do to put me in the best headspace to execute today in the markets. So daily routines, your weekly routines, you're logging positions, you're reviewing them from the week, you're back testing the week, things like that. Your monthly your monthly checklist as well. We're going back over the data. We're publishing the trade journal. We're reviewing it. We're doing our deeper ASRs on a monthly basis. When are we doing the things that we know that we need to do? Routines and processes. What is it that we need to do? And when is it that we need to do it? Processes and routine. So step to create one. Make a PowerPoint presentation. I'll put a link in the description of my trading plan with a template with all the headings that you can then just go fill in all of your information within if you wish. Steps to create one. You want to have define your trading goals. What are your goals? Why do you trade? What do you want to get out of trading? What is the lifestyle that you want to live? Get really, 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 really present and detailed with the goals that you wish trading to assist manifest. Number 2, choose and develop your market analysis methods. What tools do you want to use? Do you want to be an EMA trader, support and resistance trader? Do you want to use them both in conjunction? Do you want to be a Fibonacci trader? All those kinds of things. We'll definitely move on to a bit more of the more specifics outside of the technicals in the following episodes of do we want to be position trader, day trader, scalper, things of that nature. However, for now, with the trade plan, what tools are we using? Are we using a Fibonacci, volume metrics, things of that nature? What other methods of analyzing the markets that you're comfortable with, selecting a trading strategy, and define your rules. So taking those tools and techniques and the market analysis methods, how can you then package those in a way that can be turned into a strategy, which is an accumulation, a sequential order of things that you need to see in the market that can then signal an entry for a setup that you know has been tested, that is profitable, that is consistent, and has scalability and longevity built into it. For example, we're going to look for the support and resistance. We're going to look for the overextended run into the support and resistance. We're looking for a candlestick formation at the support and resistance, and then maybe we're looking for a lower time frame break of structure within that area of interest to then take that position. It's a sequential 1, 2, 3, 4. Then we're looking to execute, and that is the trading strategy. Where are you putting your stop? Where are you putting your target? Again, these are all things within the trading strategy. Incorporate risk management techniques. Again, this is putting in 1%, 2%. How much am I risking? Up draw, down draw, things of that nature. Make a risk management page and an outline in paper. I'm only risking 1% on my account balance at any position so that I'm able to consistently and scalably execute in the markets. And then build out the routines and processes. What are you doing on a daily basis when you wake up? What's a pre-market routine, a post-market routine? Are you checking the news announcements twice a day, once a day? Are you checking the markets at the session opens? Are you checking them once a day? Find out when works for you relative to your trading strategy and your lifestyle. You want to be doing the things that you know that you need to be doing. And then refer to it regularly. Don't just make this document, have a trade plan, and let it sit in your Google Docs for however long, or print it off and then don't ever look at it. This is something that you need to refer to as a Bible that you can utilize as your own trading coach. This is something that you have built. This is a document that you built that is going to be assisting with the capital generation and the trading process that you are going to execute over the longer term that you know works. It's been tested. It's been built so that there is scalability and longevity in mind. It's not something that you want to look at and cringe and go, oh, fuck, these are rules that I don't want to follow. This is something that is built by me to ensure that I am acting in a mature and structured way in an otherwise very erratic, unstructured, and boundaryless environment. So in summary, why you should have one, elements of a trade plan, and then steps to create a plan. I've done more than enough rambling in this video to then dive into more in the summary, but make a trade plan. Treat it like a business. Every business has a business plan. A trading business for a trader is no different. Make a plan, stick to it, make it fun, make it inspiring, and not this document that you resent. It's to help you be the best trader that you can be. There's a few elements of the trade plan that as a minimum to make sure that you're covering a few of the bases, and then go create it. Just go open up a spreadsheet, open up a Word document, open up a PowerPoint, use the template that I'm going to put in the description, and fill it out. And it's not one thing that you need to make perfect off the bat. it's going to be changed, it's going to be tweaked, it's going to be brought into more alignment with your plan. The most important thing is just making a plan, and then we can adjust it down the line. We can add things to it down the line. But for now, make a plan. If you're only trading one setup, put it in. If you're only taking one execution, one setup, put it in the plan. Outline how you're going to execute, how much you're going to risk, and stick to it and refer to it. And that is going to be the method in which you judge and base and grade your performance as a trader against, not the P&L. Not the P&L. So with that being said, thank you very much for the time today. That was week 1 all done and dusted. Next week we are going into, well, tomorrow actually we're going to go into the trading strategies and the time horizon. So this is the discussion of like, all right, are you a full-time employee and you can't scalp the New York Open because you're at work at that time, for example? We're not going to be a scalper. Do you have all the time on your hands? So maybe swing trading isn't the more favored approach. It's a little bit too hands off. The time horizons and the trading strategies are very important in analyzing and really integrating the characteristics and the behavior of a trader, outlining and deciding how often you want to trade and why you want to trade, when you want to trade. These are all questions that will be brought under consideration in the next episode. So with that being said, thank you very much for your time, and I'll see you in the next one.